Hi, everyone. Welcome back to another episode of Built to Scale. And if you're watching this on video, if you're watching this on YouTube, you can quite clearly tell that my background looks much different than normal. While I'm recording this, and by the time that this probably gets deployed, that'll be different. But while I'm recording this, I'm currently out of the country. I'm traveling. So people are aware, just a little personal flavor of me. My family is, or my wife's family is Chilean. My wife is Chilean. We like to come down here to Chile to spend time with her family that I am blessed with great in-laws. But as you can also tell, some of these episodes are being distributed during summertime, and it is the opposite season down here. We are entering wintertime down here in Chile, and so I'm recording this from my father-in-law's office, and very blessed that he's given me the chance to be able to spend time here and still get some things done while I'm traveling. But you can tell I'm wearing the fleece, having to stay a little bit warm here, that it is, we are headed into wintertime. And so while some of our guest recordings, they're going to show up in t-shirts or they're going to show up in, really light summer clothing. I'm going to be a little warm down here, and we're trying to stay warm. And so, appreciate everybody joining today. That, we decided a little while ago that although we love interviewing guests, that we also love the opportunity, or we would enjoy the opportunity to share direct insights, where we would do solo episodes. That we find like it can be a nice balance to ultimately have some guest interviews while we can and get their highlights and get their insights from our guests and their deep expertise. But also the team at Brady CFO gets the opportunity to ultimately share our insights and our perspectives and our knowledge, hopefully with the intent that, we can help educate our audience of business owners, especially construction business owners, and help them grow their business. And so today's episode, the best place to start with sometimes creating, content and creating these episodes is actually answering the questions that we get during some of our prospect meetings, because we figure if some of our sales calls and our prospects are asking these types of questions, we're sure that others have these same type of questions. And so this is our opportunity to elaborate and kind of go one by one through some of those questions. So you'll be seeing some solo episodes in which we do that ultimately we're deriving these questions from things that people have directly asked us before. And so we just figured, hey, why not answer that for the community? Why not answer that for our listeners? And so today's question really revolves around, what's the difference between a controller and a CFO? What's the difference? And especially, where does a fractional controller and a fractional CFO fit? And granted, I'm going to be a little bit biased in this because these are the services that we sell within Brady CFO. But there's a real market need for these types of services. And so let me explain first, what does a controller do for a construction business and what should they be focused on? So like anything, just like a sales position, right? You can have different flavors of a sales position. That you can have an account manager that really isn't focused on going out and bringing new sales in, but is instead focused on maintaining that client relationship and trying to maintain reoccurring revenues, if not to potentially, extract more revenues out of that client relationship. Alternatively, you have people that are focused on new business development. Their objective and goal is to bring in new business. Alternatively, you can have, sales versus marketing, right? So every domain of business has flavors of this, right? Let me explain the controller role. So even within the controller position, I should say, you can have a junior controller and you can have a more senior controller. A junior controller is generally going to be somebody that is newer to the role, the first 1 to 5 years in the role. They may not have a ton of personnel management experience where they're managing teams and have had experience of walking through difficult circumstances. And I would say one of the most best learning experiences in life is recruiting and hiring a person and having to let that person go and having to ultimately fire or terminate that person for underperformance. I don't wish that upon anybody, but I kind of do, because as a supervisor or boss, you learn so much from that experience, that when you are directly when you are directly exposed to that and you're directly responsible for that employee's success and their ability to get their job done and having to make the difficult call as to whether they should stay on the team or not because of whether they are able to, whether they have the capacity to do their job, there's no greater learning experience. Now, do I wish upon people that they have to fire people or that they should be in a position to fire people? No. But there's nothing quite like that experience of managing a team. And I would say that's where kind of a junior controller is going to come in. Controllers are primarily going to focus on executing month-end close and producing really quality financial reporting. There's flavors and modulars that are added on to that controller based upon whether they're more junior or senior. But a controller by definition is going to focus on getting really, really good accounting records and really, really good financial reporting. Now you could be asking, hey, what's the difference between that and say if I had like an accountant, like a singular accountant versus a controller, what's the difference? I would say that a controller is the best position when you have a team of accountants and you have many activities that have to be managed, and a controller is going to sit there and manage everything. And then you could be asking the question, well, what's the difference between an accounting manager and controller? I would say a really good controller is going to help define what the financial reports need to look like, because ownership and leadership is begging questions of the historical financials, and the controller is able to create new systems and to create adaptations of the financial reporting to meet the needs of ownership and leadership within the company. Let me give an example. Say an owner says, I'm looking that, especially a construction business owners, that I have all this job costing per job, but I'm struggling to see, and I really need to be able to see the reporting on our P&L by divisions. Like I want to see, hey, I have this division in this geographical area, and I want to understand the success of that division, not just the jobs, but the success of the division and what it looks like in regards to how that division's being managed, even from an overhead perspective, because you could have really great job costing of direct costs related to the jobs in that division, but you could be missing insight in regards to, okay, but how much of my management time and overhead, my SG&A, my sales, general administrative expenses, how much of that needs to be allocated so that I actually have visibility into whether that division's making money, not just on the jobs, but even from an overhead perspective is properly covering their overhead costs and producing a net profit at the bottom line. The difference between an accounting manager and a controller is that I would say an accounting manager is probably going to need to take significant direction and management from a top leader or an owner. It could be both, but is going to need to take significant direction in regards to the design of that functionality of divisional reporting. Alternatively, a good controller is actually going to create the roadmap to get there. That once they hear from ownership that I want to get there, the controller is going to create the roadmap with a mutual feedback loop from ownership and leadership that, hey, I really need a little bit more of this. I really need a little bit more of that. But the idea being that the controller has the capacity to create the design for that themselves and still execute a quality month-end close. They are going to close the books on a monthly basis, get it done well, get it done sharp, get it done on time, and yet still give you the historical reporting information that you need. That's where a controller is absolutely going to succeed. That's the difference between an accounting manager. Is accounting manager is going to need more oversight and supervision than a controller. And so you might have somebody on your team today that maybe has the controller title, but is operating more like an accounting manager. And that may be true. And I'm sorry for that. The definition of a really good controller is that they can operate independently and hear what the organization needs from a historical reporting and analytics standpoint and be able to help deliver that. So that's going to be the main focus of a really good controller. Now, back to where I started, a junior controller they may not be really superior yet. Like they may need some experience, that they may still need some levels of hand holding, some management, but it's not the idea like an accounting manager where you kind of know in your gut, this person, I'm going to have to continuously do this, while a junior controller, for an owner or leader, is going to have to understand that, hey, I may just have to do this for a period of time until they are independent enough to be able to do this on their own. I'm going to need to be able to supervise or oversee a little bit of what they're doing, a little bit more, in order for me to feel confident that they're good to go. Alternatively, somebody that's really strong as a senior controller, they've been in that seat, and you shouldn't expect to have to provide so significant guidance to what they're doing. You should be able to highlight, this is what I'm trying to achieve, and they have a feedback loop that tells you, okay, this is how long I think it'll take. This is what is necessary to make this happen, and ultimately to accomplish the goal. So the other thing that a controller can do, especially a senior controller, is they can already start performing some of those CFO duties. And what do I mean by that? So what are CFO duties? A CFO is going to focus on taking that historical reporting from a controller and forecasting and making decisions with it. And so a CFO is going to be involved a lot more in regards to budgeting, forecasting, developing scenarios for growth, helping to answer questions. Can we hire this next round of employees? What should we be paying them? How should we develop the compensation plans? Can we afford that new piece of equipment? How should we finance it? Should we pay it in cash or not? What's my cash balance going to be at the end of this period? Am I going to meet my loan covenants, my liquidity covenants with the bank? Hey, I need a bigger line of credit. I need help going and getting that bigger line of credit. I need bonding. I need somebody to manage the bonding relationship to make sure that the bonding agent or the rep has enough visibility in regards to how we're performing financially to have confidence to give us all the bonding capacity we need. That's what a CFO is going to focus on, as well as other things. I'm going to deep dive that later. A good senior controller, as they progress through their career, is going to focus and be able to accomplish several of those CFO activities. A big focus being on cash flow forecasting, various ranges of forecasting, being able to intermediate between the bank and the bonding reps, et cetera. They're going to be able to take on more and more of those duties as they get senior. Now, let me answer a question in regards to, okay, where should a fractional controller fit in? It's our belief that a fractional controller should really come in on the senior side. They should be able to accomplish a lot of the activities that I'm talking about, that executing a really good month-end close, getting quality historical reporting to ownership and leadership, as well as doing budgeting and forecasting, ultimately helping ownership be able to manage the day-to-day finances of that business and really providing oversight of it, really taking lead in that position. That's really what a senior controller, and especially somebody that's coming in fractional, should have the capabilities at minimum to do that. They shouldn't be on the junior side. They should be very senior with all the capabilities to do those functions. So then the question becomes, okay, so what's the difference between a CFO and controller if some senior controllers begin to take on the activities of a CFO? I would say a really strong, dedicated CFO is just going to have a much more future-focused mindset. How do we build this business? How do we reduce tax liabilities? How do we make sure that we have the financing for growth? How do we manage third-party relationships between our financing providers, whether those could be equity investors, whether those could be credit, lending relationships, those could be the CPA, those could be the bonding company. And the difference between a senior controller and their involvement with third-party relationships is a senior controller could have the capability to say, go talk with your CPA, and if the CPA needs to do a third-party assurance, such as an audit or a review, the controller can intermediate with them and ultimately, hey, get them everything they need, work with them to be able to accomplish the audit or the review, all is well. To me, the definition of managing the relationship is something different. And what I mean by management of the relationship, where a CFO comes in, is determining, is this even the CPA party that we want to use? Is this the bank that's going to be the right banking partner for us as we grow over the next 3 to 5 years? Is this the bonding relationship that we need? And they know how to go navigate and shop those relationships and bring solutions back to ownership to make sure that from a total cash flow financing, getting proper third party assurance, having great tax partners, like they're the ones quarterbacking all those relationships and making sure that if there are gaps in the incumbent existing relationships today, they will help fill those gaps. Alternatively, I would say a controller is going to focus more on working with the existing relationships, but may not have the mindset or the capacity in regards to going about shopping for the right solutions in the marketplace amongst third-party relationships. And your needs are going to evolve and grow, right? That especially if you're going into multi-state projects, you're going to need a SALT tax partner. You're going to need tax advice related to very specific state and local municipalities, et cetera, and the tax code related to each of those, as well as sales tax, use tax, gross receipts tax. And so you're going to need to invest in being able to analyze the market for these third-party relationships to get the expertise that you need. And you're going to need somebody to manage those relationships, meaning, hey, is that person doing a good job or not? And those are activities that oftentimes a lot of owners take on, that they'll have somebody in an accounting management role, and the ownership will manage those relationships. A CFO steps in and takes care of all that for the owner. And what does this do for the owner? Well, it frees up the owner and their time to focus on much more strategic objectives in regards to how do we grow this business? How do we set culture? How do I lead team members? It frees them up time to focus on bigger activities of especially delegating a lot of things and building a team to take their business to the next level. All the while, the CFO is going to focus on managing these relationships, making sure that the business has external financing options to grow, making sure that the business manages its cash, and make sure that there's enough cash to grow, managing tax liabilities and trying to reduce the amount of taxes paid. But in addition, a CFO is really going to help focus on growing that business. They're going to be a strategic advisor helping you as an owner to ultimately grow the value of your business, as well as what do we do with our excess cash? We find ourselves a lot in Brady CFO that for a lot of our clients, if they have multiple great years where they have great liquidity built up in their business, one, it's a liability to maintain too much cash in your business. And so it's good to deploy it. And you also want a good return on investment. And, in this market, savings accounts are paying between 2 to 3%. That's not a great ROI. And so how can you redeploy that cash and ultimately obtain a great return, but also minimize your taxes? And so a lot of times what we're helping a lot of contractors do is to invest in real estate that maybe they've been renting an office and they need a bigger office as they grow. Well, they can own that piece of real estate. And so they ultimately can go own that piece of real estate, rent it back to their construction business, but they can go remodel that real estate, and all of the remodel, all of the expenses related to remodeling or the building that they purchased itself, they can do what's called cost segregation, and they can depreciate a lot of that building and their remodel work and all their labor, et cetera. And so they can depreciate that and use that to offset tax liabilities. And I should say they can use it to offset taxable income to reduce tax liabilities. And so the question, or the idea that CFOs are helping to answer, is how are we using our financial resources to produce the best ROI? And how are we helping these owners grow this business? And that might even include acquiring other businesses, right? Or that might include buying out other partners, that you might have partners in the business that are not carrying their weight or not a good strategic fit for the business going forward. Well, we have to make a plan for how to buy them out. And then we have to make a plan for how do we finance buying them out, because a lot of, partners are going to want to be paid something, but how do we create a reasonable financing plan that the business can sustain over a period of time to buy them out, right? Either that, or, hey, we do want to grow. There's opportunities, say as a general contractor, that maybe we can go purchase some specialty subs and absorb that in our business because we use so much of their services that that's a good strategic investment for us. Well, we can help you go buy that asset and figure out how to structure it so that you reduce your tax liabilities as you buy it, and figure out how to finance it and bring in outside financing, whether that be equity or credit financing. We will go shop banks and try to go get loans to help you buy it, or we'll go find, equity partners to help you go buy it. The idea is that a CFO is going to be a real strategic partner. If your CFO is focused on day-to-day accounting, you don't have a CFO. And neither should even a controller be focused on day-to-day accounting. A controller is going to focus on making sure that there's really top-notch historical reporting. They can begin to delve in, especially as a senior controller, they can delve into more CFO-level duties. But then some businesses, especially, we've seen this a lot, when there's a lot of entities involved, the consolidation of all those entities and the planning around all those entities, because you have to think that, especially in the US, a lot of entities are set up as with pass-through taxation. And what that means is that you're not taxed at the corporate level within the entity. So you don't pay your tax liabilities there. All of the income is actually passed down, all the taxable income is passed down to your personal tax returns. And so if you have 5 different entities with different things going on, including real estate holdings, et cetera, all that consolidates down into your personal income tax return. What's the problem? Well, if you're only focused on your operating entity and your CFO isn't considering all the entities, which they have to be, if they're not considering a consolidated view and helping to develop a financial plan against all the entities, you could have a major tax liability coming from one of the entities. While your main operating entity may not be that bad, you could have something looming over in one of your other entities that completely wipes you out and would require a cash disbursement from your operating entity that you didn't plan for, and that could really reduce your liquidity, right? And that could be a problem when you go for renewal of your line of credit to the bank, because they say you took a bunch of cash out of this business and it doesn't have enough liquidity for us to feel comfortable to continue to loan you these dollars. And then that puts your bonding at jeopardy. So the idea is that a CFO is going to come in, especially when there's consolidation, when there's multiple entities, that they are going to help create a plan around managing all of those entities. So again, in summary, a controller in a construction business is going to focus a lot on historical financial reporting. And that could be across multiple entities, but they're going to focus a lot on quality historical reporting. They're going to focus on some, especially senior controllers, which we feel that from a fractional standpoint, if you're hiring a fractional controller, they should not be new in that position. They should be an in-depth controller that can handle these activities. If in an interview, they're talking about, specifics as to how they manage payroll or specifics as to how they manage daily AP, you probably don't have a senior controller, because they should have elevated themselves to have team members that manage those daily activities. So if that's a lot of what you're getting in the interview, you probably don't have a senior controller, and we recommend that's not going to be a great fractional controller fit. What you have is an accountant. Alternatively, where a CFO is going to focus is a lot on this strategy that I mentioned, thinking about how do we manage the finances of the business and get the best ROI out of all the financial resources of this business. All of these assets that are inside this business, however they are financed and however they need to be financed in the future, how are we getting the best ROI out of this and helping and sitting right at the right hand of ownership and being their strategic partner? We like to say within Brady CFO, we have some core values. We act like owners. That means to us that we have a fiduciary responsibility to do what's in the best interest of ownership. And that means we are seeking the best ROI and the best stewardship of those financial resources. We want to make sure that that owner, even though that sometimes you need to make some risk and you need to take some risk and make some bets, that owner is protecting those financial resources, but ultimately maximizing the ROI that they can get out of them. That's the goal of a CFO. And so if anybody has additional questions about that, about how to make sure that they're getting a good fit between a controller and CFO, and fractional versus not, happy to answer those questions. Please reach out to me. My email is mason@bradycfo.com. I will be happy to answer your questions. But I just appreciate for those that are listening in today that hopefully this was helpful to define what you need, that we're walking into a lot of client situations, especially if they've never had a controller CFO, trying to make sure that there's a right fit for their needs. And I would say most clients, if they don't have an existing controller today, that's where you got to start, is you might need a fractional controller. And that's where I would say that you start. You don't immediately go for the CFO. That a CFO, sitting with, a variety of accountants, that sometimes that can fit. It's very often that it's the right fit, but it sometimes can. I just want our audience to be careful because there is a trend of a lot of fractional CFOs even selling themselves as these strategic CFOs, but really they're operating more like a controller. And you're paying top dollar for a CFO that really isn't doing CFO level duties and isn't thinking like a CFO and operating and helping you like a CFO. And so I just really want to make sure that there's a right fit. And if you ever have questions, we're happy to answer that. We're happy to hop on a call. We can have a chat and just make sure that you feel comfortable with who you're hiring, what you're doing. So please don't hesitate to reach out. Thank you for listening in today. And hopefully this was helpful. Thanks, everybody. See ya.
Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it. See you.